Welcome to video 3 of part 1 of the EA Tax Training free EA exam prep course for 2026. Tom here, back with you to discuss capital gains. There's a lot of technical material in this video, and some of the concepts will also be applicable in part 2, business taxation. So watch it as many times as you need to and study the slides and free resources. Specifically, what we will cover in this video are the types of property in the tax law, basis of assets, capital gains and losses, and then non-taxable and other sales. Our free resources from irs.gov, the first two you'll recognize from the other videos. For this video in particular, we've got Schedule D and Form 8949 and their instructions. That's where capital gains are actually recorded on the tax return. So it's important that you read those. And then also Publication 544, Sales and Other Dispositions of Assets. On our flow of the tax return, we are still at the very top talking about gross income. So let's get right into our first topic. We need to understand the different types of property that are mentioned in the tax law. So when you are reading the forms and instructions and the law itself, or listening to these videos, you understand what the IRS means by these different types of property. Our first categories of property, we've got investment property and business property. So investment property is property that produces investment income. So stocks, bonds, treasury bills, even rental real estate are considered investment property. Next is business property. This is property that is used in a trade or business. So this can be buildings, computers, equipment, trucks, or any other property that is used in a business. Then we look at tangible versus intangible property. Tangible property means it is physical in nature, so you can reach out and touch it. And then intangible property is not physical in nature. So it would include things like computer software, patents, trademarks, licenses, customer lists, things like that. So one example would be a computer. If you've got a laptop computer, the computer itself is tangible property, but all the software that runs on the computer is intangible property. So that is one example. Next, we need to discuss depreciable property. We will cover depreciation and depreciable property in detail in part 2. But for part 1, it is important to at least understand the concept, because you will hear about depreciation and something called depreciation recapture. So first of all, depreciation is only applicable to certain types of business or rental type of property. It's not something you need to worry about for your personal assets. So what is depreciation expense? It is a deduction for the cost of property used in a business or income-producing activity spread out over the estimated useful life of that property. So when you spend money in a business, you generally get to deduct it. If you are buying an asset that is going to last several years, or you expect it to last several years, then you're generally not going to deduct it all in the year that you pay for it. Instead, you're going to spread out that expense over its estimated useful life. So that is what depreciation is all about. So you're taking into account that most assets that you buy are going to wear out over time, and eventually they're not going to be useful to you at all. So examples of the types of property that are depreciable are buildings, machinery, equipment, computers, vehicles, furnitures, etc. One exception to the depreciable property concept is land. Land is not depreciable because it's not considered to wear out over time. So since the useful life is quote unquote forever, we do not depreciate land. Our next category is a very important one. You're going to hear it a lot. It's real property versus personal property. We did touch on this briefly in our last video, but real property is land, buildings, equipment, and fixtures that are attached to land or buildings, such as building systems like heating and air conditioning systems, plumbing. Anything built into a building itself is considered part of that building. So for real property, think of real estate. That's what it means. Personal property is everything else, or you can think of it as property that can be moved. When we say personal, again, we don't mean that it's property that's not used in a business, that is used for personal use. We just use the word personal to distinguish it from real property. So, real estate is real property, everything else is personal property. And again, you will see this distinction frequently in the tax law. Next is capital assets versus non-capital assets. So we'll start with the definition of non-capital assets. There are specific categories of assets that do not result in a capital gain when that asset is sold. So those are considered to be non-capital assets. So the gain or loss when you sell those is ordinary income. Ordinary income, again, means it's taxed just like all of your other income, like your salary and wages, your interest income, your dividends, etc. That is ordinary income. Capital assets, then, are any asset that are not considered non-capital. So if they are not on the list of assets that are not capital assets, then they are capital assets. When you sell a capital asset, it is treated as a capital gain or loss. Why is that important? Because capital gains, or specifically something called long-term capital gains, are taxed at a lower tax rate than ordinary gains. So we've got these special capital gains tax rates that we'll talk about in this video that are lower than ordinary tax rates. Therefore, taxpayers generally prefer capital gains because if it's a long-term capital gain, it is taxed at a lower rate. Capital losses, on the other hand, are limited, while ordinary losses are not. And ordinary losses can be used to offset ordinary income. Therefore, taxpayers generally prefer ordinary losses. So this is an important concept as we go through this video because we're talking about capital gains or non-capital gains. Why do we care? We care because we generally prefer capital gains and ordinary losses. So what is this list of non-capital assets? Well, here it is on your screen. First of all, property that is held for sale to customers, otherwise known as inventory. That is not a capital asset. You sell inventory in your business, it is an ordinary gain. Depreciable property used in a trade or business, not a capital asset. Real property used in a trade or business, not a capital asset. Why is that separated out? Well, remember, land is a type of real property and it is not depreciable. Therefore, it is listed separately here on the list. Next, intellectual property, such as patents, copyrights, secret formulas that are held by the person who created them or who received it as a gift from that person, are not capital assets. So if you are an inventor and you have a patent that you created, that is not a capital asset in your hands. If you sell it to someone else, they buy it, it would be a capital asset for them, but it is not for you. Next is accounts receivable in a business, not capital. Then certain U.S. government publications, including the Congressional Record, unless they were purchased at the price available to the general public. So this is kind of the oddball one on the list. But what this is saying is if you get a U.S. government publication and you don't have to pay for it, or you don't have to pay very much for it, then that is not a capital asset. If you get to sell that, you are not going to get favorable tax treatment on the gain on that sale. If, however, you purchased that government publications at the normal price, then it would be a capital asset. Next on the list are certain commodities derivative instruments that are held by dealers. So dealers, as we will discuss later, are sort of merchants in the investment world. So they buy investments in order to resell those to customers. So it's kind of like inventory. So these commodities derivative instruments, when they are held by dealers, they are not capital assets. Next are hedging transactions. So this is another investment concept. But when you enter into a hedging transaction, you are buying an asset that you do not expect to make a profit on. You are buying it to hedge another asset that you have. When you buy an asset as a hedge, it's really more like buying insurance. It's like insurance expense rather than a true asset that you are trying to make a profit on. Therefore, it is not a capital asset. And then finally, supplies used in a trade or business. So you're going to see that one of the common themes of most of the things on here is that in one way or another, it has to do with operating a business, inventory in the business, property used in the business, accounts receivable, supplies, even intellectual property. If you're an inventor, that's the business you're in, then that patent that you get is not considered a capital asset. The government publications, again, is a bit of an oddball one, but even the commodities derivatives, that's for a dealer who's in the business of dealing with investments. So you can see using an asset in a business setting will frequently result in it not being a capital asset. So, what this results in is that almost everything you own as an individual is a capital asset. Your house, your car, your furniture, your clothing, your investments that you own, your collectibles that you own, all of that is a capital asset. It's more about how the asset is used than the type of asset. So if you have a car as an individual, that is a capital asset. But if a business has that exact same car, it is not a capital asset. Same way with the computer that you own. You own it yourself, capital asset. Business owns it, not a capital asset. So now let's talk about the basis of assets. This is sometimes called the cost basis. This is a very important concept because, again, it's going to be referred to frequently in the tax law. So you need to determine the basis of an asset in order, first and foremost, to determine the gain or loss when you sell that asset. So if you want to know how much taxable gain or loss do I have from selling this asset, you need to know the basis of that asset. It's also used to determine depreciation for some assets. So when we have depreciation expense, how do we know how much to depreciate? Well, it's based on the basis of that asset. It also determines the amount to put on a business's balance sheet. So in part two, we're going to talk about the financial statements. One of those is the balance sheet, where you list, among other things, your assets. Well, the amount that you put on the balance sheet for those assets is going to be based on their basis. Also, the tax law will often refer to an assets basis. And then it has other miscellaneous uses in the tax law as well. When we talk about the basis, the easiest way to think about it is the amount you have invested in that particular asset. So if you buy a treadmill, for example, for $1,000 and you pay $70 in sales tax, your basis in that treadmill is $1,070. So that leads us to determining the gain or loss on the sale of an asset. In order to determine the gain or loss, and this is whether it is a capital asset or not a capital asset, it doesn't matter, you subtract your basis in the asset from the sales price. So in the simplest cases, the basis is equal to the cost, how much you paid for the asset. So that treadmill, if we bought it and our basis is $1,070, if we were somehow able to sell that treadmill for more than we paid for it, which isn't likely, but for sake of argument, if we could sell that treadmill for $1,570, we would have a $500 gain on the sale of that treadmill. So here's another example. You bought 20 shares of stock in XYZ Corporation for $500 or $25 per share on June 1st of 2023. On June 1st of 2025, you sold 10 of those shares for $300 or $30 per share. You have a long-term capital gain of $50 on that sale. So it's 10 shares at $5 profit per share. So again, pretty simple concept. Sales price minus basis equals your gain or loss. Costs. So when we talk about cost or cost basis, what does that include? Well, just like with our treadmill, it doesn't only include the price of the asset itself, it also includes any expenses related to the sale, such as sales tax, such as commissions that you had to pay, fees, closing costs, etc. So, for example, you buy 100 shares of stock in XYZ Corporation at $10 per share. You incur brokerage fees of $20. Your basis in the stock is $1,020 or $10.20 per share. So, in our last stock example, we just kind of ignored the fact that usually you're going to have to pay some sorts of fees when you buy stocks. So here we're not ignoring those fees anymore. And you can see that those fees do get rolled into the cost basis of that stock. Example two, you buy a car for $30,000. You pay sales tax of $2,400, a delivery fee of $400, and a dealer administrative fee of $200. Your basis in the car is $33,000. So even though you look at the sticker and it says $30,000, your basis is actually $33,000. For real property, your basis is almost never going to equal the purchase price. There are always going to be other costs. These can be found on the closing statement. So if you've ever bought a house, then you are familiar with all of these fees that you may not have been expecting when you walked in there. So when you look at that closing statement, you're going to see recording fees, appraisal fees, abstract fees, survey costs, title insurance, and there can be others. Most of those things are going to get rolled into the basis of that real property. Now, one thing that it does not include, and you'll want to remember this for the exam, it does not include loan fees and points. So the loan is a separate thing from the property because you could buy the property without a loan. Some people just happen to take out a loan to buy their real property, but those fees and points and everything are separate from the property itself, so we do not include those. If you are constructing a building rather than buying it, all of the expenses of construction are included, including materials, labor, permit fees, inspection fees. All of those type of costs of constructing that building are included. If demolition is done prior to building, so you have to knock down an old building before you build your new building, those demolition costs are added to the basis of the land rather than to the building. Why does this matter? Well, if this is a building that we are using in a business, for example, it will be depreciable. So we would rather have those demolition costs added to the building because then we can depreciate them, expense them over time. Remember, land is not depreciable. So when we add that to the land, we do not get to depreciate it. So if we had our druthers, we would add the demolition costs to the cost of the building rather than to the land. But we don't have our druthers. We have to add those costs to the basis of the land. Basis increase after purchase. So it is possible with an asset to have an increase in its basis after the initial purchase of the asset. And this can happen with any type of asset, but it's most common with real property. So if you make major improvements or additions to that property, then your basis increases by the cost of those improvements or additions. So for example, if you have a building and you add a room or you add a driveway or a fence or landscaping or flooring or major systems like a new air conditioner, all of those things would go into and increase the basis of that real property. However, repairs to those items would not. So you do not increase basis for maintenance, such as painting, fixing leaks, filling holes or cracks, or replacing broken hardware. So if you fill a hole in the driveway, that is a repair. You do not add that to the basis. But if you add a whole new driveway, that is an addition that does get added to the basis of that property. If you fix the air conditioner, not added to the basis. You add a whole new air conditioner, it is added to the basis, and so on. Just as you can have an increase in basis after you purchase an asset, you can also have a decrease in basis. By far, the most common decrease you're going to have is depreciation expense. So anytime you get a tax deduction for an asset, that deduction is going to decrease your basis in the asset. The most common deduction you are going to get is depreciation expense. If you buy a delivery truck for a business, for example, and it costs $50,000, and let's just say, to simplify it, that you deduct $10,000 a year for 5 years. Well, your basis is going to start out at $50,000. After the first year, you're going to take $10,000 of depreciation, so it's going to go to $40,000. After the next year, it's going to be $30,000 and then $20,000, etc., until it is finally zero. So each time you take depreciation expense, that reduces your basis. Any other tax expenses or losses from that property would also reduce the basis. So if you have a casualty loss related to an asset that you take on your tax return, that would reduce the basis. Any rebates that you get, so you pay $1,000 for an asset, but you get a $100 rebate, your basis is going to be $900. And then any money that is received to reimburse for a loss. So if you have property that is damaged, for example, and you get an insurance payout for that, that insurance payout will decrease the basis. Now, if you then use that insurance money to improve the asset again, that could add to the basis. Let's say, for example, your roof was ruined in a hailstorm. You got an insurance payout. That is going to decrease your basis. But then if you reinvest that money and put on a new roof, that would then increase your basis. So you could end up back around the same place you were before you got the insurance payoff. But the insurance proceeds themselves do decrease the basis. Stock dividends and splits. In part one of the EA exam, since we're not dealing so much with businesses, many of the basis type of issues are going to relate to stocks and bonds and other securities. So we're going to see a lot of securities related topics in this video. The first one here is stock dividends and splits. So as we discussed in our last video, stock dividends and splits are usually not taxable. However, they will affect your basis in each share of the stock. So what you do is you take your basis in the original shares and you divide by the number of new shares. So let's look at a couple of examples. Example 1, Terrence bought 100 shares of BCD Corp for $1,000, making his basis $10 per share. BCD Corp then issued a stock dividend of 0.2 of a share per share. So Terrence now owns 120 shares. So when he gets that stock dividend, that is not taxable income, as we discussed in our last video, but now his basis per share is lower. So what you do is you take his overall basis, which is still $1,000 because he has invested $1,000 in this stock. But now he has 120 shares. So his basis per share is $8.33. Example 2. Sandra bought 100 shares of XYZ Corp for $1,000, making her basis $10 per share. Later, XYZ Corp announced a stock split of 3-to-1. So Sandra now owns 300 shares, but her overall basis is still $1,000. So to determine her basis per share, we take $1,000 divided by the 300 shares that she now has. So it is $3.33 per share. So if she sells just 100 shares, we know what her basis is. It's 100 times $3.33. But remember, in both cases, whether it is a stock dividend or a stock split, focus on the amount of money that they have actually invested in the asset, and then divide that by the number of shares that they now own. That will give you the new basis per share. Non-dividend distributions. Sometimes corporations will make a distribution to their shareholders that is not a dividend, and they will identify it as such on the 1099 div. That distribution is not currently taxed. It is considered a return of your investment. So that reduces your basis in that stock. So when you sell it, your taxable gain will then be proportionally greater. So, for example, Terrence bought 100 shares of BCD Corp for $1,000, making his basis $10 per share. BCD Corp then made a non-dividend distribution to Terrence of $100 in cash. So now Terrence's basis in the stock is $900. So what's his total investment in the stock? Well, originally he invested $1,000, but he got $100 of that back. So now he has only invested $900 in that stock. So his basis is $9 per share. Inherited or gifted property. So the basis of inherited property is fair market value at the date of death, or if elected by the estate, 6 months after the date of death. So when somebody dies, their assets are going to go to someone. So their heir who gets that asset, they get something called a step up in basis. Their basis is considered the fair market value at the date of death. Or as it says, the executor of the estate can make this election instead that says they're going to use the date 6 months after the date of death. But that is not an election that you as the heir get to make unless you happen to be the executor. But if you are not the executor, you don't get to decide which date that you use. So generally, we're going to use the date of death. But this step up in basis is a good thing for the heir because we're going to contrast that with gifted property. So the basis of gifted property, so this is when somebody gives it away when they're still alive, that is called carryover basis. So the basis is the same for the donee, the one who receives the gift, as for the donor. Let's say you have someone who bought Walmart stock back in 1986. They hold on to it all these years. Then in 2025, they sell that stock. Do you think they're going to have much of a taxable gain? Well, of course they are. I don't know how much they paid for that Walmart stock back in 1986, but it's not much compared to how much it's worth in 2025. So if that person sells that stock in 2025, assuming they had quite a few shares of it, they're going to have a very large capital gain that they are going to have to pay tax on. But let's say instead of selling the stock, they die while still owning the stock. And now that stock passes to their only child. And let's say the only child gets the stock shortly after the date of death, and then they sell the stock immediately. That child is not going to have a large capital gain because their basis in the stock is the fair market value on the date of death. They don't have to use the basis of their parent. They get this step up in basis to the current fair market value. So that is a great deal for them from a tax standpoint. Not so great that their parent died, but from a tax standpoint, it's a great deal. Contrast that with gifted property. So let's go back to our example. Let's say that parent, the day before they died, gave that Walmart stock to their only child. Now, that only child's basis is the same as their parent. So if they turn around and sell that, they are going to have a huge capital gain. So this is actually a planning point when you are talking to people when they're getting their will together and they're doing basic estate type of planning. They may want to consider holding on to any appreciated assets, so assets that have gone up in value since they bought them. Rather than giving those away, they may want to consider waiting and bequeathing those upon death rather than giving it while they are still alive. There is one exception to this gifted property carryover rule. If the property is sold at a loss, then the basis is the lesser of the donor's basis or the fair market value. So let's say you've got some stock and the fair market value is actually less than you paid for the stock. If you then give that to someone, their basis is not your basis. Their basis is the fair market value on the date of the gift. So this is to prevent people from transferring losses to a family member, for instance, who might be able to use that loss, whereas the donor could not use the loss. So in general, basis of gifted property is the same for the donee or the donor, but if the property is sold as a loss, then we use the lesser of the donor's basis or its fair market value on the date of the gift. Fair market value. You're going to hear this phrase a lot in the tax law. So, what does fair market value mean? It is the price at which property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. So let's say you've got somebody who wants to sell a car. They're not desperate to sell that car, but they're willing to sell it. And you've got somebody else who might be interested in buying a car. They don't really need the car right away. It's not a big emergency, but they'd be willing to buy a car. And then let's also say that they both have got all the knowledge of all the relevant facts. So it's not like it's got a bad transmission and the seller knows that and the buyer doesn't. The buyer knows all the relevant facts that the seller knows about that car. The price that they would agree on for the sale of that car, that would be fair market value. So obviously, this is kind of a hypothetical, a perfect case example, but that is what fair market value means in the tax law. So now let's talk about capital gains and losses. After all, the title of this video is capital gains. So let's go back to that concept of capital assets. So there are two categories of capital assets. There are capital assets that are held for investment, and there are capital assets that are held for personal use. So first, capital assets held for investment. So this is things like stocks, stock rights, bonds, etc., unless they are held by a securities dealer. Because again, the dealer is in the business of selling those, so it is not a capital asset for them. Also, collectibles such as gold, silver, stamps, coins, etc., again, unless they are held by a dealer. The gains on the sale of investment property are taxed as capital gains. So again, if it's a long-term capital gain, you're going to get those favorable tax rates. Any losses are deducted as capital losses. So again, remember, capital losses, the amount that we can take is limited. But in any case, capital assets that are held for investment, the gain or loss on the sale will be treated as a capital gain or loss. Capital assets held for personal use. So this is property that is held for personal use only, not as an investment. So this would be your family home, your car, your furniture, your clothing, etc. The gains on the sale of personal use capital property are taxed as capital gains. However, the losses are not deductible. That's why when you sell your old car that you bought for $30,000 and now you're selling it for $10,000, you do not get to take a tax loss for that sale. If you sell your home at a loss, you do not get to take a loss for that sale. So if it's investment property, you can take a capital loss. If it is personal property, you cannot take a capital loss. If you have a gain, it doesn't matter if it's investment or personal, you do have to pay tax on that gain. Now let's talk about long-term and short-term gains, because remember, it is only long-term capital gains that get that favorable tax treatment. So long-term means that you held the asset for more than 1 year. And inherited property automatically counts as long-term. So if a person bought an asset 2 months before they died, their heirs get to treat that as a long-term asset. The gain or loss on the sale of a long-term asset is a capital gain or loss, and it is taxed at favorable capital gains rates. A short-term capital asset is one that is held for 1 year or less, and the gain or loss on the sale is a short-term capital gain or loss, and the gains are taxed at ordinary rates. So if it's a short-term gain, there's no real benefit to it being a capital gain rather than an ordinary gain because they're both going to be taxed at ordinary tax rates. You will want to remember this more than 1 year and 1 year or less because this could be tested on the exam. They may say that the person bought a stock, for instance, on July 1st of 2024 and they sold it on July 1st of 2025, and you need to know whether that is a long-term or a short-term gain. In this case, that would be a short-term gain because they held it for 1 year exactly. So short-term is 1 year or less. Long-term is more than 1 year. Capital losses. You can deduct capital losses up to the amount of your capital gains plus an additional $3,000 per year or $1,500 married filing separately. And note that the amount of the loss allowed is the same for single, head of household, qualifying surviving spouse, and married filing jointly. So married filing jointly does not get twice as much as single. The only one that's different is married filing separately, where they only get $1,500. But for everybody else, it is $3,000. So this is why we say capital losses are limited. So for example, let's say you've got some stock that you paid $10,000 for and you sell it for $4,000. And that's the only sale or loss you had for the year. So you had a $6,000 loss on the sale of that stock. You can only deduct $3,000 of that loss this year. Now, excess losses can be carried over to be used in future years. So in our example, you would have another $3,000 that you could carry over to use next year. But in any 1 year, you can only take $3,000. As we'll see later, you can offset current year capital losses against current year capital gains. So if you sold this $10,000 stock for $4,000, you had a $6,000 loss, but you had another stock that you sold and you made a profit of $10,000, you could offset the $10,000 profit with the $6,000 loss and report a net capital gain of $4,000. But if you don't have any capital gains to offset the loss with, you are limited to this $3,000. So let's talk about that netting process. How do you actually calculate net capital gains or loss? So when we talk about net or netting, we mean you're offsetting the positives with the negatives. That's what that means. So the first thing you're going to do in steps 1 and 2, you can do in either order. You don't have to do 1 first and then 2. You could do it vice versa. But in any case, you're going to total all of your short-term gains and subtract all of your short-term losses. That is going to leave you with a net short-term capital gain or loss. Then you're going to total all of your long-term gains and subtract all of your long-term losses. That will leave you with a net long-term capital gain or loss. If those positions are opposite, so one of those is a net gain and the other is a net loss, then you will net those two together and get either an overall net gain or loss. If those positions are the same, so they're either both gains or both losses, then no further netting is necessary, and you have two different kinds of income or loss. So this is going to leave you with 4 possible outcomes that we will look at on this chart. You could end up with a net short-term gain. In that case, you will pay tax on that gain at ordinary income tax rates. You don't get any break because it is short-term. Or you could end up with a net short-term loss. In that case, that loss is deductible up to $3,000. Any remainder is carried forward. Or you could end up with a net long-term gain. In that case, that gain is taxed at the favorable capital gains tax rates. Or lastly, you could end up with a net long-term loss, which again, that is deductible up to that $3,000, and then the remainder is carried forward. And in a little while, we're going to look at a couple of examples so you can see how this works. Capital loss carry forwards. As we said, any excess above that $3,000 can be carried forward, and it can be carried forward indefinitely. But if the taxpayer dies, any unused losses are lost. So for example, let's say you have a $40,000 capital loss in 2025. And then for simplicity's sake, let's say you don't have any other capital gains or losses forever. You'd be able to take $3,000 of that $40,000 loss in 2025. Then you could take $3,000 in 2026, then $3,000 in 2027, in 2028, etc., until the entire $40,000 is used up. However, if you die in the meantime, anything that's left over, nobody gets to take. You can take $3,000 in your year of death, but after that, they are gone. If losses are carried forward from a previous year as part of the netting process, short-term carryover losses are netted against current short-term gains, and long-term carryover losses are netted against current long-term gains. So let's look at a couple of examples. Jerry had the following capital gains and losses in 2025. Long-term gains and losses. He sold some stock for a $2,000 gain. He sold a mutual fund for a $3,000 loss, and he sold a different stock for a $5,000 loss. Short term, he sold a stock for a $2,000 gain and a different stock for a $1,000 loss. So first, we're going to net the long-term gains and losses together. That is a $6,000 net long-term loss. So he had a $2,000 gain on this stock, but then he had a $3,000 loss and a $5,000 loss. So the net of that is a $6,000 long-term loss. Short term, he had a $1,000 gain, $2,000 gain on one stock and $1,000 loss on the other stock. So his net, you net those two together because they are opposite. His net is a $5,000 long-term loss. So Jerry is single, so he can use $3,000 of that $5,000 loss to offset his ordinary income in 2025. The remaining $2,000 is a carry forward to next year. So next year it is a net long-term loss. So he will net that $2,000 carry forward against any long-term gains in 2026. If he can't use them in 2026, he can carry them forward to 2027, etc. Example 2. Julie had the following capital gains and losses in 2025. Long term, she sold some stock for a $3,000 gain, sold a different stock for a $2,000 gain, and sold a third stock for a $1,000 loss. Short term, she sold a stock for a $3,000 gain and another stock for a $2,000 loss. She also has a $2,000 long-term capital loss carry forward from last year, from 2024. So when we look at her net long-term gain is $2,000. She had the $3,000 gain here, $2,000 gain there, that's $5,000, minus the $1,000 loss, that's $4,000, minus the $2,000 long-term carry forward. So that leaves her with $2,000 of net long-term gain. Her net short-term gain is $1,000. That's the $3,000 gain here minus this $2,000 loss. So for her, we're not going to net those two together because they go the same direction. So she is also single. She will pay capital gains rates on the $2,000 long-term gain and ordinary tax rates on the $1,000 short-term gain, and she has no carry forward remaining. It was all used up. How do we report these gains and losses? Well, we are going to start on the Form 8949, and here is what page 1 looks like. So let's zoom in. So you can see part 1 here is for short-term transactions. First thing is you are going to check one and only one of these boxes. And this is new for 2025. There only used to be these first 3 boxes. They have added 3 boxes for 2025. These final 3 boxes are specifically for transactions related to digital assets. So the first 3 boxes is for your more typical securities, like through a brokerage house, stocks, bonds, mutual funds. And then the last 3 boxes are for digital assets. Let's focus for now on the ones from the 1099-B. For short-term transactions that were reported on a 1099-B, such as from a brokerage house, and that show the basis on that 1099-B, you are going to check this box. That is going to be the box you most frequently check. Most often, when you get the 1099-B, it will show the basis of that asset. So if you had a stock, you bought it, you sold it, the brokerage house knows how much you bought it for. They know how much you sold it for. So they will report your basis in that stock. However, that's not always going to be the case. There could be a situation where maybe you transferred the asset from another brokerage house and somehow the information didn't get transferred over and they won't know the basis. So in that case, they will not show you the basis. And so you would check B. And then C, you're going to check for short-term transactions that you don't get a 1099-B for. So you could be selling an asset that you don't hold at a brokerage house. And so you would use box C for that. If you have a mixture, so let's say you've got a brokerage statement, so you've got some things with a 1099-B that show the basis, but then you also sold some assets that were not through a brokerage house, but you need to report the gain. What do you do then? What you do is you attach another 8949. So we only check one box here. Then you would do another 8949 and check the other box and report that transaction. So then you're going to go down here and you're going to list each of those transactions, when you acquired it, when you sold it, how much you sold it for, what your basis was. You've got some codes or adjustments that you may have that would be on your 1099-B. Then you're going to report your gain or loss. And then at the bottom, you will total up all of your gains and losses. Then you'll go to page 2, which shows your long-term gains or losses. So you're going to have the same boxes here, except that it's for long-term transactions instead of short-term transactions. Once again, you're only going to check one box. Then you are again going to show all of the same things. The description of the property, the dates, the amounts comes up with your gain or loss. Once you have all of your short-term and long-term gains and losses from all of your 8949s, those are then going to flow up to Schedule D. So this is the front page of Schedule D. Let's zoom in again. And here again, part 1 is short-term capital gains and losses. So you can see all of the totals from the 8949s. It is possible in some instances to skip the 8949 and just report all of the amounts on Schedule D. I'm not going to go into detail on that right here. That's why you want to get these forms and read through the instructions so you can see when you need to do that. But just be aware when you're actually preparing returns that it is possible sometimes to skip the step with the 8949. But in any case, you're going to show all of your short-term gains and losses. Then you're going to show all of your long-term gains and losses. And then you are going to go to the second page, which is a summary where you're going to show the total of your short term, the total of your long term to come down to your net gain or loss that will be reported on the 1040. So now let's talk about those lower capital gains rates. I've been kind of teasing you all along with this idea that long-term capital gains are taxed at lower rates than ordinary income. But what are those lower rates? Well, here is our chart. So first we're going to start with our filing status, single, married, filing jointly, etc. Then we need to know the taxpayer's taxable income. Once we know those two things, then we can locate them here on the chart. So for instance, if you have a single person whose taxable income is less than $48,350, then they will pay 0% capital gains tax. So no tax on capital gains if their income is less than that $48,350. Contrast that to if that were ordinary income or a short-term gain, then they would pay 10 to 12% tax on that, depending on exactly where they fell within this tax bracket. And then all the other filing statuses work the same way. So for instance, if you have a couple who is married filing jointly, and they've got taxable income between this $96,701 and $600,050. Any capital gains that they have will be taxed at 15%. And then you can see for our higher income taxpayers, they would pay capital gains at a rate of 20%. So you will want to remember these rates, the 0, 15, and 20% for the exam. But the big takeaway here is because it is a long-term capital gain, they are saving between 7% and 20% in tax. So it really is a big incentive to have a long-term capital gain. These ordinary rates here, we will go into detail in video 5. You'll want to know those as well. But for this video, the big thing is to understand the 0, 15, and 20% and to remember those numbers. You do not have to remember the exact cutoffs for each of these. Just be generally familiar with this chart and know the capital gains rates. I'm sure you noticed the asterisk here, so there are some exceptions. These things we will cover as we go throughout this video, but they are capital gains. It's just that they can potentially be taxed at a little bit higher rates, up to the amounts that are shown here on the chart. But the vast majority of capital gains will be taxed at the normal 0, 15, and 20% rates. Securities sales. Many of the capital gains transactions that you will deal with, both in real life and on the EA exam, especially part 1 of the EA exam, will involve securities, stocks, bonds, mutual funds, etc. These will usually be reported on a 1099-B from the brokerage house. And as we said, they will often provide both sales price and the basis and all the dates. So usually you'll have everything you need for the 8949 and or the Schedule D just from the 1099-B. And it's important to know that mutual funds can generate capital gains in 2 different ways. First of all, the gains that the fund has from buying and selling securities. So remember, a mutual fund is when lots of people put their money in. So I put some money in, you put some money in, other people put money in, and then the mutual fund manager pools all of our money together, and then they go out and invest that money. They buy stocks and bonds, etc. Not only are they buying stocks and bonds, etc., likely they are selling stocks and bonds, etc. So they are buying and they are selling. So there are going to be capital gains and losses that are generated from that activity. When they do that, those capital gains and losses will be reported out to you as the mutual fund owner. So that is one way you will have capital gains from a mutual fund. The other way is by selling your shares in the mutual fund itself. So you buy the mutual fund, you keep it for a while, and eventually you say, you know what, I'm going to sell this fund now. Well, you are going to have a gain or loss on the sale of your shares of the mutual fund. So that's the second way you can have a capital gain from a mutual fund. So let's talk about those capital gain distributions. So this is when the mutual fund buys and sells securities, and then they distribute out those capital gains to you as the mutual fund owner. Long-term capital gains that the mutual fund has will be reported as capital gain distributions. That's what it says on the 1099. So those are treated as long-term capital gains on your tax return. Even if you owned the mutual fund for less than a year, if the mutual fund is reporting those as long-term, you report them as long-term. Because what it means is that the mutual fund themselves held that security for more than a year. Therefore, it is a long-term capital gain. Short-term capital gains will just be reported as ordinary dividends. It's going to go in the box in the 1099 that says ordinary dividends. That is not going to distinguish short-term capital gains from dividends that were received by the mutual fund. Any ordinary income that that mutual fund generated is going to be reported to you as an ordinary dividend. So what this means is you cannot use short-term capital gains from the mutual fund to offset your other capital losses, because the mutual fund is not going to tell you how much of those ordinary dividends is capital gain versus just dividends that they received. So this is actually a disadvantage of owning a mutual fund. Obviously, the long-term gains will be reported to you separately, so you can use those to offset any long-term capital losses that you may have. But the short-term gains, since you're not going to know how much of those ordinary dividends represents capital gains, you cannot use any of that amount to offset your other short-term capital losses. Liquidating distributions. When a corporation is partially or completely liquidating, and we'll talk all about that in part 2, but when they do that, so they're selling off all their assets, paying off their debts, and distributing out to their owners what is left over. The first amounts that they distribute out are a return of basis. It is not taxable. So if you invested $1,000 in a stock and then that corporation liquidates and they give you $1,500, that's your share. The first $1,000, they're just giving you your money back that you invested. So that is not taxable. You think about it just as if you had sold that stock. You paid $1,000 for the stock. You sold it for $1,500. You only pay tax on the $500 gain. The first $1,000 that you get is just a return of your investment. So it's the same way if you get a liquidating distribution from a corporation. And of course, it will be labeled as a liquidating distribution. So you will know that. Any amount that you get in excess of your basis is then a capital gain. So if you get $1,500, you have a $500 capital gain, just like you sold the stock for $1,500. If you get less than your basis in the total liquidation, then you have a capital loss. Company goes out of business, they sell all their assets, they pay off all their debts, you get $700, let's say, even though you invested $1,000. Well, that's just like selling your $1,000 of stock for $700, so you get a $300 capital loss. Worthless securities. So stocks, stock rights, and bonds that become completely worthless during the tax year are treated as if they were sold for $0 on the last day of the tax year. And you do report this on an 8949. So let's say you have a stock, company goes out of business, and they're not even able to pay off all of their debts. So there is nothing left for the shareholders. So your stock is now completely worthless. You treat that as if you sold it on the last day of the year for $0. So if you're trying to determine, is it long-term or short-term, you look at the date you bought it, you compare that to the last day of the year in which it became worthless. And if it's more than a year, it's long-term. If it's less than a year, then it is short-term. You must, however, be able to support the total worthlessness. You cannot just decide, this is worthless, I'm going to take a tax write-off. You've got to be able to prove, hey, look, this company went out of business and they no longer exist, and so it's worthless. Or if it was a bond you owned, maybe they went into bankruptcy, and as part of the bankruptcy, those bonds were wiped out and they said, nope, they're not paying any of it back. So you can show that, yes, those bonds were worthless. Or something similar depending on what the circumstances were. Wash sales. A wash sale occurs when you sell stock or securities at a loss, and within 30 days before or after that sale, you buy substantially identical stock or securities, you acquire substantially identical stock or securities in a trade, you enter into a contract or option to acquire substantially identical stock or securities, or you acquire substantially identical stock or securities in your IRA or Roth IRA. So what are we talking about here? Well, at some point in time, some investors had a bright idea. What they did is it would get to be December and they would look at their stock portfolio. And let's say they had some stock that they had paid $10,000 for. And then they look up the price of the stock now in December. They see that that stock is only worth $6,000. And they say, you know what? I still like this stock. I know it's gone down to $6,000, but I think it's going to come back. And I think it's long-term going to be a good investment. So I want to hold on to the stock. But here's what I'm going to do. I'm going to sell the stock today for $6,000, take a $4,000 loss, and then I'm going to buy $6,000 worth of the stock tomorrow because the price tomorrow is probably not going to be much different than it is today. So I'll sell it today, take a $4,000 loss, buy it back tomorrow, still own the stock, and now I've got a $4,000 capital loss that I can use on my tax return. So the IRS says, no, 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 you cannot do that. That is a wash sale. One transaction basically washes out and negates the other. And you can't do it the other way around either. You can't say, okay, I'm going to buy $6,000 worth of stock today, then I'll sell that $10,000 that I had purchased tomorrow for $6,000 and take the loss. Either way, whether it's before or after, you can't do it. You also can't say, well, I'll sell it in my taxable account and I will purchase it in my Roth IRA or my regular IRA. Again, you cannot do that. So wash sales are not deductible. If you have one of these transactions through a brokerage house, then it will usually be actually identified. It's one of those codes that's on that 8949 that we kind of glossed over when we were looking at the form. One of those codes is for a wash sale, and so you'll know that you are not able to take that loss. Do note, though, that this does not apply to gains. If you have a gain on the sale, even if you buy it and sell it within 30 days, you do still have to report the gain on your return. Options. The gain or loss from the sale or trade of an option to buy or sell property that would be a capital asset in your hands is a capital gain or loss. So if you got an option on an asset, and that asset, if you were to buy it, would be a capital asset, then the option itself is also a capital asset. And so if you sell the option, the gain or loss is going to be a capital gain or loss. So for example, stock options. Stock options can be readily bought and sold on the stock market. So what this is saying is that those are capital assets, as long as that stock would be a capital asset if you purchased it. If you have a loss from an option because you did not exercise it, it is considered a sale and a capital loss. So let's say you bought a stock option. You had a stock whose price was $20, and you thought that that price was going to go up. And so you bought an option to buy that stock 3 months from now for $21. So you were thinking that 3 months from now, that stock is going to be worth more than $21. So I'm going to buy an option to buy it for $21. So if it's worth, let's say, $25 3 months from now, then I can buy the stock at $21, sell it for $25, and I'll make a nice little profit. But let's say things don't go quite as planned, and 3 months comes by, and that stock is only selling for $19. Well, your stock option is worthless. Nobody is going to pay you for an option to buy a stock for $21 when they can just go out and buy the stock themselves for $19. So what's going to happen is that stock option is going to expire and it is going to be worthless. So you can take a loss for the cost of that stock option once it expires. If the option is part of a straddle, so this is a way people reduce risk, where they buy one option to buy a stock and another option to sell the stock, you generally don't report the gain or loss until both positions have settled. So they may not be exactly the same time period. So you wait to report any gain or loss until both options have settled. Incentive stock options. This is a repeat slide from our last video, so I'm just reminding you of it. If you get an incentive stock option from your employer, as long as it is a statutory option, which most of them are, then there is no income on that when you receive that option. You don't pay any tax on it until you sell the actual stock itself. If it happens to be a non-statutory stock option, then you do include the value of that at the time you receive the option, as long as that value can be determined. If you can't determine the value, then it is taxable when the option itself is either exercised or sold. In either case, the gain that you ultimately have will be treated as a capital gain. Employee stock purchase plans. This is a corporate benefit that allows employees to purchase the company's stock at a discount. If it is a qualified employee stock purchase plan, no income is going to be recognized until the stock is sold. If you sold that stock more than 24 months after the offering date and more than 12 months after the purchase date, then you get favorable tax treatment. So when they have one of these plans, they'll say, okay, we're going to allow you to buy company stock at a discount starting on a certain date, and you've got until some other date in order to buy it if you want to take advantage of this deal. So if you sell that stock, if it was more than 2 years after that offering date and more than a year after you actually purchased it, then you do get favorable treatment. The gain will be a mix of ordinary gain and capital gain. The idea here is part of your gain is a capital gain on an investment, but part of the gain is really kind of compensation. You got a break on the purchase price of this stock, and you got that break because you were an employee of the company. So the gain that you have is going to be a mix of capital gain and ordinary gain. You do not have to worry about computing how much is how much. You will get this form, this 3922 from the employer. They have a calculation that they will do, and it will show you the amount that is ordinary and the amount that is capital. All you need to remember for the exam is if you've got an employee stock purchase plan, it has this special rule. You're going to have a mix of capital and ordinary, and you've got the 24-month and 12-month rule. Publicly traded partnerships. A PTP is any partnership with ownership units traded on an established securities market or with units that are readily tradable on a secondary market. So a publicly traded partnership is a partnership that is treated like a corporation. So you buy and sell partnership units just like you buy and sell shares of stock. So by default, these PTPs are treated as if they were corporations and as if it was stock, in which case your gain or loss is very straightforward. It's just like selling a stock. You bought the PTP for so much per unit, you sold it for so much per unit, then you've got a gain or loss accordingly, just like we have been discussing. However, if 90% or more of that partnership's income comes from certain types of passive income, it will be treated as a partnership rather than as a corporation, which means the PTP owners will get a K1 from that partnership. Any losses that flow through from that K1 are going to be subject to the passive activity loss rules. Remember, you can only deduct losses from passive activities from gains from passive activities. You cannot use passive activity losses to offset non-passive income. So what they're saying is if the vast majority of your income within that partnership is passive income, we're not going to let you treat that as if it was actually stock in a corporation. We're going to treat you as if it were a true partnership, and we're going to make you issue a K1. Just know that the vast majority of PTPs are not going to do this. This rule is put in place to prevent them from doing it, so they're not going to do it. So in general, when you have a publicly traded partnership, it is going to be bought and sold just like a stock. But if they do meet this 90% test, then they are going to be treated like a partnership. If they are treated like a partnership, any cash distributions can lower the basis. Just like, remember when we talked about stocks and we talked about non-dividend distributions? It's the same idea here. If this PTP is being treated like a partnership and you're getting a distribution from that partnership, that is going to lower your basis in that partnership. So when you later resell that PTP, you're going to have a larger gain than you otherwise would have had because you've already gotten some of that cash back. Also, because of some complex partnership rules, some of the gain when you do sell it could be considered ordinary gain rather than capital gain. So again, this is just for those PTPs that have 90% or more of their income being passive income, not for your typical PTP that's being traded like a stock. Small business stock, or Section 1244. We are going to talk about a couple of different Internal Revenue Code sections, so you'll want to remember these to kind of distinguish them. So this is Section 1244 stock. This is stock in a domestic small business corporation that is primarily operating a business rather than investing, and you are the original owner of the stock. So this is a company that you started and you're actually operating a business. You're not just investing money. If you sell that stock, or if you go out of business, the stock becomes worthless. The loss on that stock can be treated as an ordinary loss up to $50,000 or $100,000 if you are married filing jointly. If you have a loss greater than that, then the excess, the remainder, will be treated as a capital loss. Any gain on the sale of Section 1244 property is a capital gain. So this is the best of both worlds. Remember, we said taxpayers prefer capital gains and ordinary losses. So that's what this gives you. For Section 1244 stock, if you sell it at a gain, it is a capital gain. So as long as it's long term, you get the favorable capital gain tax rates. If you sell it at a loss, or if it becomes worthless, which means the business fails, you go out of business, you get to treat that loss as an ordinary loss. So you can use it to offset ordinary income up to these limits. We have a similar concept with a small business investment company, or SBIC, and it is one that is licensed and operated under the Small Business Investment Act of 1958. Any loss on the sale or worthlessness is an ordinary loss, and any gain on the sale is a capital gain. So again, it is the best of both worlds. And with this one, there is no limitation. So you don't have that $50,000 limitation like you do with the Section 1244 stock. Next is Section 1202 stock, otherwise known as qualified small business stock. Usually we just call it Section 1202 stock. This is for certain C corporations that are operating qualifying businesses, and the stock has been held for at least 5 years. So there are some rules with this. Some of the main rules are it has to have gross assets of $50 million or less at all times since the company has existed. The stock has to have been acquired at original issue or as compensation, or sometimes if it was inherited or gifted. So this is basically for the people who founded the company or for employees who got stock in the company as compensation. You must meet the active business test, and it must have been a C corporation substantially the entire time. So this has to be an active, real business, not just investing. It's actually running a real business, and there are other requirements. So if you have one of these, you have to be very careful about do they meet the qualifications or not, because there are very specific qualifications. However, if you do meet the qualifications, this is a fantastic deal. Your clients will love you for this because it can save them a ton of money. If you meet the qualifications, you can exclude the gain on the sale of that stock up to $10 million or 10 times the initial basis, whichever is greater. So you start a company, it's a C corporation, you meet all this criteria, you end up selling it years later, you can exclude up to $10 million of the gain on the sale of that stock. No tax whatsoever. If you have greater than that $10 million or 10 times initial basis in gain, then that excess gain is one of those asterisk items on the capital gains chart, Section 1202 gain, in excess of the amount that is excluded. It is a capital gain. However, it is taxed at the taxpayer's normal tax rates up to a maximum of 25%. Now you can see there are these other dates. If you acquired the stock before February 17th of 2009, then you can only exclude 50% of the gain. If it was between these dates in 2009 and 2010, you can exclude up to 75%. If it was acquired after September 27th of 2010, then you can exclude this entire gain. There are some new rules instituted by the OBBBA regarding Section 1202 stock, and these rules are favorable. But this applies only for stock that was acquired after July 4th, 2025. So this is going to be for people who sell their stock in the future, not for people who have sold their stock in 2025, because it would be a rare case that you acquired the stock after July 4th of 2025 and also sold it in 2025 for a large gain. But for any stock that was acquired after July 4th, 2025, that asset limit is increased from $50 million to $75 million. So remember, we said one of the qualifications was the corporation's assets must have been $50 million or less for the entire existence of the corporation. Well, if the stock was acquired after July 4th of 2025, that goes up to $75 million. Also, the cap on excluded gains is increased from $10 million to $15 million, or $7.5 million married filing separately. One change that OBBBA did make for stock acquired before July 4th of 2025 is, that $10 million limit on the amount of gain that you can exclude? It used to be you got that $10 million whether you were married filing jointly or married filing separately. But OBBBA changed that to $5 million if you are married filing separately. It's $10 million still for everyone else. Also, these amounts will be indexed for inflation starting in 2027. Used to be they were not indexed for inflation. Then also for this stock acquired after July 4th of 2025, there is a partial exclusion that is possible. So if you held the stock for 5 years or more, you get the full $15 million exclusion. If you held it for 3 years or more, you can exclude 50%. And if you held it for 4 years or more, you can exclude 75%. And of course, if you held it for more than 5 years, it is 100% up to the $15 million. Now let's change gears and talk about investors, dealers, and traders. So we need to understand the distinction between these. Investors buy and sell securities and expect income from dividends, interest, or capital appreciation. Typically, they hold securities for a substantial period of time. They are not in the business of investing. So this is most of us. This is most of the investing public. We are simply investors. We are investing in stocks and in mutual funds. We're holding on to them and we're hoping to get dividends, or we're hoping that the stock is going to rise in value and we are going to make a profit. For us, the sales of those securities result in capital gains and losses. It's going to be either short term or long term, depending on how long we owned it. And it's going to be subject to all the normal capital loss limitations. Next are dealers. Dealers purchase securities and resell them to their customers, and they may keep an inventory. They derive their income from marketing securities to customers or by being compensated for services provided as an intermediary or market maker. They must use something called the mark-to-market rules that we will be talking about here shortly. So dealers, these are the merchants of the securities industry. They own securities in order to resell them. Traders, so think about day traders. Traders are in the business of buying and selling securities for their own account. They are considered a business, even though they have no inventory and no customers, but they must meet all of the following conditions. They must seek to profit from daily market movements. Their activity must be substantial, and they must carry on the activity with continuity and regularity. So in other words, this is their business, or this is their job, basically, is every day or nearly every day, they are trying to buy and sell and to make a profit. They are the day traders that we think about. For them, they can report their expenses on Schedule C along with their income. However, they do not have to pay self-employment tax. And they can elect to use those mark-to-market rules that we talked about. So what does mark-to-market mean? If you are following mark-to-market, any securities that you hold at the end of the year must be treated as if they were sold at their fair market value on the last business day of the year, and you have to recognize any gain or loss that results. So for most of us, those of us who are investors, if we buy, for instance, a stock, we don't recognize any gain or loss until we sell that stock. If you are using mark to market, you have to look at the end of the year, the last business day of the year. You have to look, how much is that security worth? What is my basis in the security? And you have to pretend as if you sold it and report the gain or loss from that. And just so you know, any gain or loss is going to increase or decrease your basis in the stock so that when you do later sell it, you don't have to pay tax twice on it, or you don't get the benefit twice from the loss. But you do have to recognize that gain or loss. So sometimes you will see in the tax law, they'll talk about a gain or loss being realized versus being recognized. You don't realize a gain or loss until you actually sell the property. So when we as investors sell our stock, we are going to realize a gain or loss, and we are going to recognize that gain or loss. Recognize means we're going to report it on a tax return. With mark to market, even though they have not yet realized a gain or loss because they haven't sold the asset yet, they still have to recognize the gain or loss on their tax return. So let's revisit who uses mark to market. Dealers must use mark to market, as we said. Traders can elect whether or not they want to use mark to market, and investors cannot use mark to market. If traders do make a valid mark to market election, all their gains and losses will be treated as ordinary and not subject to the capital loss limitations, and the wash sale rules do not apply. So if you're a day trader and you make this election, you do not get the benefit of long-term capital gains rates. However, you do not have that $3,000 per year limitation on capital losses, and you don't have to worry about the wash sale rules. You can still take a loss even if you buy and sell the same stock within 30 days. So if you're a true day trader, you may not be keeping assets for more than a year anyway, so you may not care about getting the benefit of the long-term capital gain treatment. But if you do have some securities that you have held for a long time and you do sell those, you don't get that long-term capital gain treatment. If the traders do not make that mark-to-market election, then their gains and losses are treated just like any other investors. So they get capital gains treatment if they're long-term capital gains, and their losses are limited. That election must be made by the due date of the prior year's tax return, and it does involve something called an accounting change that we'll talk about in part 2. Revoking the election must also be done by the due date of the tax return for the year it becomes effective. So once you make this mark-to-market election, you have to keep using it unless and until you revoke that election. And you have to make the election by April 15th because you have to make it by the due date of the prior year's tax return. So if you want the mark-to-market election to be in effect for 2025, you must have made the election by April 15th of 2025. Similarly, if you want to revoke the election, so let's say you had it in place from 2024. If you put it in place in 2024, then in 2025, if you want it to still be in place, you don't have to do anything. But if you want to revoke it in 2025, you have to revoke it by April 15th. You can't wait until December in order to make the election, because that would be great. You could just wait and see how you did. Gets to be December, you say, well, I have a lot of losses. I don't want those losses to be limited, So I'm going to go ahead and make the mark-to-market election. Or conversely, say, wow, I've got a lot of long-term gains here. I'd really like to take advantage of those long-term capital gains tax rates. So I'm not going to make a mark-to-market election. Well, you cannot do that. You have to decide and make the election or revoke the election by April 15th. Section 1256 contracts. For these special types of contracts called Section 1256 contracts, everybody has to use mark-to-market. Doesn't matter if you're an investor, trader, or dealer. And it is any of these listed on the slide. Regulated futures contract, foreign currency contract, non-equity option, dealer equity option, and dealer securities futures contract. You don't have to understand what all of those are. Just know that they're on the list, and specifically remember that it is a Section 1256 contract. With these contracts, any of them that you hold at the end of the year have to be treated as if they were sold at their fair market value on the last business day of the year. And then you must recognize any gain or loss that results. So that is mark to market. This does not apply to hedging transactions. So if you are buying one of these Section 1256 contract assets just as a hedge to protect some other asset that you own, you can label it as such ahead of time, and then you do not have to apply the mark-to-market rules. But for all other Section 1256 contracts, you do. These contracts have a special treatment. It's called the 60-40 rule. 60% of your capital gain or loss will be considered long-term, and 40% will be considered short-term. So it doesn't matter how long you actually held them. 60% is long-term, 40% is short-term. So remember that 1256 contract, mark-to-market, 60% long-term, 40% short-term. Digital assets or cryptocurrency and similar type of assets. For federal tax purposes, digital assets are treated as property. So the general tax principles applicable to property apply to these transactions. So they are not considered currency. They are considered property. So it's just like a stock or a bond, for example. You will remember on page 1 of the 1040, you've got that checkbox where you have to declare whether or not you had any of these digital asset transactions. And then also remember, just from this video, we looked at the 8949, and it now has a place on there. We have to check the box and report any of these transactions right on the 8949, which then goes to the Schedule D. A taxable gain or loss can result from transactions involving digital assets, including but not limited to all of these: a sale of that digital asset itself, an exchange of that digital asset for property, goods, or services, an exchange or trade of one digital asset for another, the receipt of a digital asset as payment for goods and services, the receipt of a new digital asset as a result of either a hard fork or of mining or staking. I hardly understand what that even means, but if you are into these digital assets, you will know what that means. The receipt of a digital asset as a result of an airdrop or any other disposition of a financial interest in a digital asset, and the receipt or transfer of a digital asset for free that does not qualify as a bona fide gift. Gains and losses are treated the same as any other. So if the sales price exceeds your basis, you've got a gain. If your basis exceeds the sales price, then you have a loss. If it is a capital gain, then it is treated as a capital gain, and any losses are limited to the same $3,000 as other capital losses. If it is ordinary income, such as crypto received by a self-employed person for performing services, treat that as gross receipts in your business at the fair market value in US dollars at the time it was received. So when that customer gave you that crypto in exchange for the services that you performed, what was the fair market value on that date? That's the amount you report on your tax return. Similarly, if you use crypto to pay expenses, you use the fair market value at the time that you made that payment. That payment could also result in a gain if the basis is lower than the fair market value. So, for example, let's say you received some crypto for performing services and it was $100 worth of services, so they gave you $100 worth of crypto. And now, months later, the value of that crypto has gone up. So you're using that same crypto to pay somebody else for $500 worth of services. Well, you now have a $400 gain on the disposition of that crypto because you got $400 more value than you received. If you want more details about this, you can see IRS Notice 2014-21. Collectibles. So collectibles are things like art, rugs, antiques, metals, gems, stamps, coins, alcoholic beverages like wine, musical instruments, historical objects, and similar assets. It includes precious metals-based ETFs or exchange-traded funds. It also includes an equity interest in a pass-through entity that holds collectibles. So if you've got a partnership or an S corp that holds collectibles, your stock in that S corp or your partnership interest in that partnership is considered a collectible. And also, the IRS can deem assets to be collectibles because obviously this can change over time. Things become hot, and all of a sudden, everybody's trying to collect this certain new thing. So the IRS can say that that is a collectible. Collectibles are capital assets, again, unless they're held by a dealer. But if you're just collecting them, when you sell it, any gain or loss is going to be a capital gain or loss. But this is one of those asterisk items on that capital gains charts. It's for collectibles. If you have a long-term capital gain from selling a collectible, it will be taxed at the lower of the taxpayer's ordinary tax rate, or 28%. So it's still a capital gain, but you don't get the normal 0, 15, 20% treatment. Instead, you pay tax at your normal tax rate. But if you're in one of those higher normal tax rate brackets, you only have to pay 28%. That's the maximum you have to pay. Losses on sales of collectibles. You cannot take a loss on the sale of a collectible unless it was held for investment. Whether or not it was held for investment depends on the intent at the time of purchase, whether it was for personal enjoyment or for expectation of a profit. And the IRS will look at the facts and circumstances on a case-by-case basis. So if we're dealing, let's say, with baseball cards, if you're buying those baseball cards because you think it's a good investment and you're selling them, maybe you buy and sell frequently. For instance, you're not really a dealer in them, but it's your hobby. You like to buy and sell baseball cards and try to make a profit. Then you'd be considered an investor and any losses would be deductible. But if you're just buying baseball cards because you like baseball cards and now you're selling them, well, that's personal use. You cannot deduct any losses from the sale of personal use assets, which includes collectibles. Bad debts. Business bad debts may be deductible. We'll talk about that in part 2. Non-business bad debts also may be deductible as a short-term capital loss, but they must meet the following criteria. First of all, it must be a genuine debt. It was not intended as a gift. And they say a loan from a parent to a minor child to pay for their basic needs is not a genuine debt. So you cannot say, okay, I'm raising my children. I am loaning them all of this money that I'm using to buy their food, pay for their clothing, medical care, etc. And someday they have to pay me back. And then, oh, look, they didn't pay me back. So that is a loss. You cannot play that kind of game. Also, you must have a basis in the debt. So you actually have to have loaned out cash or something of value. You cannot get a bad debt just because you did not receive something that you should have. So, for example, if your ex doesn't pay you child support when they're supposed to, that is not a bad debt. You cannot deduct that from your tax return. If you do have a bad debt, you can deduct it in the year that it becomes worthless, which means there's no longer any chance that it will be repaid. And you're going to have to be able to prove that it is in fact worthless. And it is subject to the $3,000 capital loss limit, but of course, any excess can be carried forward to future years. Sales of non-capital assets. So it is possible that you could sell a non-capital asset, but that is almost always going to be a business transaction. So you will report that on the appropriate business tax form, which will be usually this form 4797. And usually if it is a non-capital asset, it will be an ordinary income or loss, but there are some exceptions to that. We will cover that in part 2. So now let's talk about non-taxable and other sales. So we've been talking about taxable sales primarily, but there are some sales that are not taxable at all or that are only partially taxable. So let's talk about those. Transactions between spouses. Generally, no gain or loss is recognized on a transfer of property between spouses, or if incident to divorce, former spouses. So you can give or buy and sell things between you as a married couple all you want to. No gain or loss is going to be recognized. If you're getting divorced, if you are transferring property back and forth as part of that divorce, then the same rule applies. Even if it happens after you're not technically married, if it was part of the divorce, then you treat it as if you were still married, and so there is no taxable event there. Any such transfer is just treated as a gift, so the receiving spouse's basis is the same as the gifting spouse, even if the property is sold for a loss. So normally, if you have a gift, you have the carryover basis, but there is an exception that says that if that property was sold for a loss, then you take the lower of the donor's basis or the fair market value of the property. That becomes the basis of that asset. But if it's between spouses, that exception does not exist. Related parties. Losses on sales between related parties cannot be deducted. So related parties means family members, a corporation and a greater than 50% owner, a fiduciary and a beneficiary of the same trust, etc. So any close type of relationship, if you have a loss, you cannot deduct it. They don't want people manufacturing tax losses by selling at a real low price just to get that tax loss, and then possibly even being able to keep using that property because you are related to that person. So you can't play those types of games. However, any gains are taxable. Sale of primary residence. So your home is a capital asset. And so the general rule is if you sell a capital asset for a gain, then it is taxable income. However, there are special rules when you are selling your primary residence, which may allow you to exclude all or part of that gain. If you qualify, you can exclude up to $250,000 of gain on the sale of your primary residence if you are single, head of household, or married filing separately. If you are married filing jointly, you can exclude up to $500,000. And what we're talking about here is the gain, not the sales price. So if you bought a house for $800,000 and you sell it for $1 million, your gain is $200,000. So as long as you meet the rules, you can exclude the entire $200,000 of that gain. But then also remember that you cannot deduct a loss on the sale of a personal capital asset, and that includes your home. So if you lose money on the sale of your house, that is not deductible. So in order to qualify for this exclusion, you have to meet both of these two tests. Really, there's 3 tests, but they call it 2 tests, so we'll go with that. Test number 1, during the 5-year period ending on the date you sold your home, you owned it for 2 or more years. That's called the ownership requirement, and lived in it as your main home for 2 or more years. That is called the use requirement. The 2 years of ownership and use do not have to be the exact same 2 years. And if you are married filing jointly, in order to qualify for the higher $500,000 exclusion, only one spouse has to meet the ownership requirement, but both spouses have to meet the use requirement. So both spouses must have lived in that house for at least 2 years out of the last 5. Then the second rule is that you can't do this more than every 2 years. So if you've excluded the gain on the sale of a primary residence in the last 2 years, you cannot exclude it again. You have to wait at least 2 years. So for most people, this test is very straightforward. Okay, you've owned your house, you've lived in it for more than 2 years, you're selling it, you can exclude $250,000 or $500,000 if you are married filing jointly. But there can be some more complicated situations, so let's look at a couple of examples. Example 1, John is single and started renting a house as a primary residence on August 1st, 2020. So he didn't own the house, he was a renter. On July 1st of 2022, he bought that house and continued to live in it until October 1st of 2022 when he got married and moved into a new house with his wife. He allowed his brother to live in that first house until he sold it on August 1st of 2025, realizing a $200,000 gain. John can exclude the entire gain because he owned the house for 3 years and 1 month, from July 1st of 22 to August 1st of 2025. So that satisfies the ownership test. And he lived in the house as his primary residence for 2 years and 2 months, from August 1st of 2020 to September 30th of 2022. So that satisfies the use test. Note that part of the time he lived in the house, he did not own the house, but that's okay. That's why we said those 2-year periods do not have to be the same 2 years. Also note here that John can exclude up to $250,000 married filing jointly or separately. So in other words, if the gain had been more than $250,000, he would have only been able to exclude $250,000. Why? Because in order to double that benefit to $500,000, both spouses had to meet the use test, and his wife never lived in that house. Therefore, he would have been maxed out at $250,000. Example 2, Maria is single and bought a house on July 1st of 2021 in New York, and she lived in it as her primary residence. On January 1st of 2023, she entered into a 2-year master's degree program in California where she rented an apartment. While she was out in California, her brother lived in her New York house. On February 1st of 2025, Maria decided to stay in California to pursue a doctorate degree and sold her New York house, realizing a gain of $200,000. Maria must pay capital gains tax on that $200,000 because even though she met the ownership test by living in the house for 3 years and 7 months, she did not meet the use test because she lived in it for only 18 months instead of the required 24 months. So she did not meet the use test. She cannot exclude any of the gain. We will revisit Maria shortly, but under these circumstances, she cannot exclude the gain. Partial exclusion of the gain. So if you don't meet the eligibility tests, you might still qualify for a partial exclusion of the gain. You qualify for this if the main reason that your home was sold was because of a change in workplace location, if it was health related, or due to other unforeseeable events. So, of course, you're going to have to be able to prove those things, but as long as you can get a partial exclusion. The exclusion amount is the percentage achieved of the failed test, or the lowest percentage if more than one of the tests was failed, multiplied by $250,000 or $500,000 if married filing jointly. So if you failed the test because you only lived in the house for 12 months instead of 24, then you can exclude half of $250,000 or $125,000. So let's revisit Maria here. Everything is the same except for the reason that she sold the house. So in this case, she went out to California not to go to school, but to accept an out-of-state assignment with her employer. At the end of the 2 years, her employer offered her a permanent position out in California. She accepted it. Well, now everything is the same. She still doesn't meet the use requirement because she only lived in it for 18 months. But the reason she sold was due to a change in workplace assignment. Therefore, she can exclude part of the gain. She lived there for 18 months, divided by 24 months times $250,000. She can exclude $187,500 of the gain. The gain was $200,000, so she does report the excess, the $12,500, as a taxable capital gain. Depreciation recapture. If you rented out your home or you took a home office deduction, you may have been entitled to a deduction for depreciation. If you sell that home, you have to recapture that depreciation. When we say recapture, that means you have to pay tax on that amount. So even if the gain could otherwise have been excluded, you met all of the requirements to exclude the gain on the sale of your home, you're still going to be taxed on the amount of depreciation that you took. This is another one of those asterisk items on that capital gains charts. We talked about Section 1250 property. This is Section 1250 property. We'll get into all of that in part 2, what all that means. But for now, just know if they sell that house, they pay tax on the amount of depreciation that they took or could have taken. It is a capital gain. However, instead of paying the 0, 15, or 20% capital gains rates, you pay your ordinary tax rate up to a maximum of 25%. And the reason for this depreciation recapture rule is to prevent a double benefit of deducting part of the cost of the house and then excluding the gain on the sale of that house. So they make you pay tax on that previous deduction that you took. So let's do an example. Lawrence is single and in the 35% tax bracket. He bought a home and rented it out for 2 years, taking $22,000 in depreciation deductions before moving into it as his primary residence. After living in the house for 3 years, he sold it for a gain of $200,000, which is excluded since he meets all of the tests. However, since he previously took that depreciation deduction of $22,000, he has to pay 25% capital gains on that deduction. So that's $22,000 times 25%, which is $5,500. Reporting a sale of your primary residence. You need to report the sale of your primary residence on a Form 8949 if either you cannot exclude all or part of the gain or you received a Form 1099-S. So a 1099-S reports the sale of real estate. So these will be issued by whoever handled the closing of the transaction. So it might be, for instance, a title company. So let's just say it's a title company that handled the closing. If there is a sale of real estate, that title company will issue a 1099-S to the seller of the real estate. However, if they reasonably believe that the real estate being sold was the seller's primary residence, they do not have to issue a 1099-S. So if you're selling a house, one of the questions they're going to ask you, and you're going to have to sign, is that I have owned this house for at least 2 years out of the last 5 years, and I have lived in this house as my primary residence for at least 2 years out of the last 5 years, and I have not excluded any gain from any other primary residence in the last 2 years. So they'll actually have you sign stating that. If you do that, they will not issue you a 1099-S. So if you don't get a 1099-S and you exclude all of the gain, you do not have to report the sale of your home on your tax return. I find this fascinating. Everyone always thinks that the IRS is all up in your business and trying to know everything about you and to get every penny that they can. But for many people, selling their house will be the largest financial transaction of their lifetime. And yet, as long as they exclude all of that gain, they don't have to report it on their tax return. Nobody reports it. The title company doesn't report it. Taxpayer doesn't report it. Nobody reports it. I just find that very interesting. If you have depreciation recapture, that is reported on line 19 of Schedule D. And of course, in that case, you will be reporting the sale on your return because part of the gain was not excluded. Foreclosure or abandonment. Normally, as we said in the last video, if a debt is forgiven, the amount forgiven is cancellation of indebtedness income, and it is taxable. There are exceptions, though, And one of them, you may recall, is called qualified principal residence indebtedness. If a home is foreclosed on, the lender accepts the proceeds from a short sale, or the owner hands over the keys to the lender and abandons it, and the lender accepts the property or the proceeds as full satisfaction of the debt, the amount of debt forgiveness may be eligible for exclusion from income. So, if one way or another you hand the keys of your house over to your lender and they accept that as satisfaction of the debt, if you meet these requirements, you can exclude that debt forgiveness from income. What are the requirements? The debt had to be to buy, build, or improve the home, or it was a refinance of a debt that was used to buy, build, or improve the home. If it was a cash out refinancing and the cash was used for something else, something other than improving the home, such as paying off another debt, then the cashed out amount is not eligible for the exclusion. And then also, this does have to be your main home. So it has to be your primary residence that you are doing this with. If you have this situation, you will get a 1099-A from the lender. So let's look at an example. Peter borrowed $200,000 to buy his house. Later, when the balance of the loan was $175,000, he refinanced his mortgage to pay off that $175,000 of the old loan, plus to cash out $25,000 to pay off his car loan. His qualified principal residence indebtedness is $175,000. Shortly thereafter, the lender foreclosed on the property and accepted the property as full payment of the loan. Peter has $25,000 of taxable debt cancellation income. So because he used that $25,000 to pay off his car loan, that portion he cannot exclude. But the other $175,000 he can, because it was a refinanced amount of an amount that was used to buy the home. If he had used that $25,000, let's say, to put a new addition onto the house, that then would have still qualified for the exclusion. And when it was foreclosed on, none of it would have been taxable. But in our case, that $25,000 is taxable. Installment sales. If you sold property at a gain and will receive one or more payments in a tax year after the year of sale, you report that as an installment sale because you are getting installments toward the sale of the property. Part of the gain will be recognized in each year that one or more payments is received, rather than all in the year of sale. So if you sell it this year, but you receive one or more payments next year or in any future year, you do not have to report all of the gain this year. You're going to report some of it this year and some of it in the year or years that you received those other payments. Now, this does not apply to any sales of stocks or securities that are traded on an exchange, and you can elect out of installment sale treatment. So if you want to recognize it all in the year of sale, you can do that. It also does not apply if there's a loss. Again, it is only if there is a gain. And you report these sales on the Form 6252 for each year in which one or more payments are received. When you receive these payments, part of each payment received will be counted as return of basis, part will be considered interest income, and part will be considered gain on sale. The gain on sale is determined by multiplying the gross profit percentage by the amount of the payment received after subtracting interest. The gross profit percentage is the gross profit on the transaction divided by the contract price. The gross profit is the sales price minus any costs of sale minus the basis. So, for example, you sell property at a contract price of $60,000 and your gross profit is $15,000. Your gross profit percentage is 25%. You take the gross profit of $15,000 divided by the sales price of $60,000, that is 25%. After subtracting interest, you report 25% of each payment as installment sale income. In other words, as gain on sale. So let's look at an example. Marcus owns vacant land that he purchased in 2020 with a basis of $30,000. In January of 2025, he enters into a contract to sell that land for $48,000 and agrees to accept 24 monthly payments of $2,000 each. He pays closing costs of $2,000. Interest on each payment is computed as $200. How much income does Marcus report for the 12 payments received in 2025? So here's the answer. First, let's compute his gross profit. His gross profit is the sales price, $48,000, minus costs of sale, which is $2,000, minus his basis, which is $30,000. So that equals $16,000. Therefore, his gross profit percentage is $16,000 divided by the $48,000 sale price, which is 33.33%. So for each $2,000 payment, $200, as we said, is going to be considered interest income. That leaves $1,800 as principal, if you will. So if you take that $1,800 times 33.33%, $600 of that will be considered installment sale income or long-term capital gain. The remaining $1,200 is a return of basis. Therefore, in 2025, Marcus has $600 times 12 payments, or $7,200 of long-term capital gain, and $200 times 12 payments, or $2,400 of interest income. And note that when you get questions on the exam, you're not going to have to compute the amount of interest. They will do what I have done here, and they will tell you what that amount of interest is. Just have to remember, for each payment, subtract the interest from the total payment. What is left, the difference between those, is what you multiply the gross profit percentage by. Like-kind exchanges, or Section 1031. Usually we just call it a Section 1031 exchange. If you trade business or investment real property solely for other business or investment real property of a like kind, you do not pay tax on any gain or deduct any loss from the trade. And you report this on this Form 8824, and you report it on Schedule D. In order to qualify as a like-kind exchange, you must meet all 6 of the following conditions that are on the slide here. First, it must be business or investment property. This is not applied to personal use property. The property traded and received must be real property, and the property must be like-kind. The good news is real estate for real estate will be considered like-kind as long as both are in the United States. So you could trade, for example, a piece of vacant land for a warehouse. That would be considered like-kind property. Next, the property must not be property held for resale. So if you are a home builder and you've built a bunch of homes that you are trying to sell to the public, you cannot get like-kind exchange treatment for exchanging one of those homes. Next, the property to be received must be identified within 45 days after the date you transfer the property given up. So when you make this exchange, you may not have actually identified the specific piece of property that you are going to receive in exchange for the property you're giving up. And that's okay, as long as that piece of property that you are going to receive is specifically identified within 45 days. Also, the property received must be received by the earlier of the 180th day after the date you transfer the property given up, or the due date, including extensions, for your tax return for the year in which the transfer of the property given up occurs. So it's the earlier of those 2 dates. So you have to identify it within 45 days of the date you give the property up, and you have to receive that property within the earlier of 180 days after you give that property up, or the due date of the tax return for the year in which the property given up occurs. You can have an exchange that is partially taxable and partially non-taxable. If you receive money or non-like-kind property, we call that boot. So money or non-like-kind property that you receive in addition to the real estate is called boot. If you receive that in addition to the real estate, you pay tax on the gain up to the amount of boot received. The taxable gain is the lesser of the actual gain, the realized gain, or the cash and fair market value of not like-kind property received, reduced by costs of the sale. So it's the lesser of your actual gain or your boot reduced by the costs of the sale. If the other party assumes a liability that you had on the property, you treat that as if it were cash received. So if you had a mortgage on the property and the other party is going to assume that mortgage, then that's just like they gave you that amount of money. If you had a $50,000 mortgage on the property and you're no longer responsible for paying that mortgage, then that's just like you received $50,000. So you have to count that as boot. If you're on the other end, if you pay money in addition to giving up that real estate, as long as all 6 of those other conditions are met, then that still counts as a completely non-taxable trade. It's only if you are receiving the boot that you have to worry about this. So let's look at an example. Alex enters into a qualifying 1031 exchange. He gives up property A with a fair market value of $110,000 and a basis of $80,000 in exchange for property B with a fair market value of $100,000. Alex also receives $10,000 in cash and pays $5,000 in closing costs. What is the resulting realized gain and taxable gain for Alex? Alex's realized gain is $25,000. It's the $100,000 of real estate that he received, plus the $10,000 of cash that he received, minus his $80,000 of basis in the property given up, minus the $5,000 that he paid in closing costs. So how much is his recognized or taxable gain? Well, that is only $5,000. It is only the $10,000 in boot that he received. In this case, it was all cash. So it's the $10,000 in cash that he received minus the $5,000 in closing costs that he paid. So he realized a $25,000 gain. He only has to pay tax on $5,000 of that gain. Next example. Everything is the same, except that in addition to the $10,000 that Alex received, the other party also assumed a $30,000 mortgage that Alex had on that property. So what is the resulting gain in that case? Well, his realized gain is now $55,000. So it's the same $25,000 that he had last time, plus the $30,000 of the mortgage that was assumed. So how much is his taxable gain? Well, it is $35,000. It's the same $5,000 that he recognized in the previous one, plus the $30,000 of mortgage that was assumed. So for the exam, you should be able to do an example like the ones that I have shown you here, and you can see publication 544 for further examples. Like-kind exchanges between related parties. If you've got related parties, they can do a like-kind exchange. That is allowed. However, if either one of them disposes of the property that was the subject of the Section 1031 exchange within 2 years, then that exchange is disqualified from non-recognition treatment. So you could have to go back and amend a tax return if either party sells their property within 2 years. This is if, again, they are related parties. They're not related parties, this doesn't matter. The gain or loss that's going to result, because you got this like-kind exchange treatment originally, so you didn't recognize the gain. So the gain or loss that has to be recognized is recognized at the time that that property is sold. So within 2 years, the property is sold, that's when you recognize the gain. And for this purpose, related parties include family members such as spouse, siblings, parent, child, etc., and entities where the party has, directly or indirectly, more than 50% ownership. So if it's a transaction between a partner and the partnership, well, if that partner's got a greater than 50% ownership in that partnership, they are related parties, and this rule would apply to them. Involuntary conversions, this is section 1033. An involuntary conversion occurs when your property is destroyed, stolen, condemned, or disposed of under the threat of condemnation, and you receive
other property or money as payment, such as insurance proceeds or a condemnation award. This is treated as a sale, and a gain or loss is generally recognized in the year that it is realized. So you compute the gain by the net payment received less the adjusted basis. That is your gain or loss. And the net payment means the amount of the payment less any costs of obtaining it. So maybe you had to get an attorney in order to get that condemnation award. You can subtract the attorney costs from the proceeds when you were determining how much you actually received for that property. Let's look at an example. Levi's workshop behind his home is destroyed by a tornado. The workshop was for personal use. His basis in the workshop is $40,000, and he received insurance proceeds of $50,000. He reports a $10,000 capital gain. Next, same facts as above, except Levi's basis in the workshop is $60,000. In that case, Levi realizes a $10,000 loss, but no loss is recognized for tax purposes since losses on personal property are not deductible. If it had been a business asset, he would have been able to take a loss on it, but since it was for personal use, no loss. When you have an involuntary conversion, the gain may be postponed if you receive or purchase a replacement property within the replacement period. The replacement period is generally 2 years. However, there's a few exceptions. If it is for real property used in a trade or business or held for investment, then it is 3 years. So if you replace that within 3 years, you can postpone that gain. It becomes 4 years for a main home if it was lost in a federal disaster area, and it is 4 years for livestock that are lost in an area that is eligible for federal assistance. So if you go out after the loss and you purchase a replacement property within this period of time, usually 2 years, then you do not have to recognize that gain. The gain is postponed. When we say it is postponed, what that means is you don't have to worry about the gain until you sell the replacement property. So it's postponed until you dispose of the replacement property. So let's do an example. Levi's workshop behind his home is destroyed by a tornado. The workshop was for personal use. His basis in the workshop is $40,000, and he received insurance proceeds of $50,000. He uses the proceeds to rebuild the workshop, which is finished the following year. He has no capital gain, and his basis in the workshop is still $40,000. So he gets out of paying tax on that $10,000 because he replaced the old workshop. Condemnations. A condemnation is the legal taking of private property by a government body for public use without the owner's consent. It is a type of involuntary conversion, and a property that is sold under a threat of condemnation also qualifies. So the classic example here is the state is building a new highway and they're condemning all the property in its path. They can't just take the property, they have to pay you the fair market value for the property. But that's what they do. They condemn it and then they buy you out. So that is a condemnation. It is a type of involuntary conversion. If it is a personal residence, then you can exclude the $250,000 or $500,000 married filing jointly, as previously discussed, as long as you meet all of the rules. And a condemnation is one of those unforeseeable events that qualifies for the partial exclusion. So even if you don't meet all of the tests all of the way, you can still get a partial exclusion if you are selling due to a condemnation. For any condemned property, even if it's not your principal residence, you can postpone the gain by buying a replacement property within the replacement period, just as we talked about with other involuntary conversions. And that is the last topic in video 3. In our next video, we will move on from income and talk about adjustments to income and deductions. So I will see you in video 4.